no let-up as we move into February, with macroeconomic and company trading statements coming thick and fast. Top down, the big feature of the week will be the latest UK industrial, manufacturing and construction output numbers as well as trade data on Friday the 10th. They'll all give us our latest look at how the British economy is doing in a post-referendum, pre-Brexit world. Bottom up, 9 FTSE 100 firms are due to offer results or trading updates or hold their annual general meeting in the coming week, and they include Randgold Resources on Monday the 6th, GlaxoSmithKline, Rio Tinto and Severn Trent on Wednesday the 8th, and EasyJet and Smith & Nephew on Thursday the 9th. But, for me, the company really capable of causing a fuss in the week ahead is BP, due to release its fourth quarter and full year results on Tuesday the 7th. Now, results from fellow oil major Royal Dutch Shell on Thursday the 2nd will have provided some kind of benchmark for performance, both for the upstream, exploration and production, and downstream, refining, chemical and petrol station businesses. Now, we also know the oil price rallied throughout most of 2016 to over $50 a barrel, having bottomed at barely 28 last January. It's around 55 as I sit here. That helps to explain the recovery in BP shares that we can see here in the first graphic. According to OPEC data, demand for oil has been pretty steady. It's been reductions in supply that have buoyed the price of crude. Oil firms have cut back on exploration work, and OPEC and non-OPEC nations have agreed to cut global daily output by around 1.5 million barrels a day between them, and that was at their November and December meetings last year. Now, OPEC's history of sticking to such productions, spotty. So bulls of oil will need to be looking ahead already to the next meeting of the oil cartel in May in Vienna. And this all matters to BP because the company states it's cash neutral in the $50 to $55 a barrel range and cash generative thereafter. And it's cash flow that pays the dividend, which equates to a yield of around 6.5% right now. The problem is that earnings only cover the dividend by half in 2016 and 1 times in 2017. So to pay the dividend and invest in its business, BP must sell assets, cut costs or borrow. That's all okay in the short-term fix, but not necessarily good for the long-term health of the operations. This next chart shows dividend cover, earnings per share divided by dividend per share. Ideally, it should be above 2 to provide some comfort. In short, the higher the oil price goes, the higher BP's profits, the better its cash flow, the safer the dividend. Though BP won't rush to cut by any means, even if it has done so twice in the last 27 years, unlike Shell. Last year's total dividend was 40 US cents a share, and for the first 3 quarters of this year, the figure was unchanged at 10 cents. So that's your benchmark for Q4. Besides the dividend, watch for comments on underlying replacement cost profitability. Upstream lost $200 million in Q3 and refining made $1.4 billion. Though as you can see, the trend in both hasn't been great. The first line is operating profit from upstream, the second from downstream, and the bars, a group level after-tax profit, where a lower tax charge has helped the bottom line. Now after that, you need to check on 3 things, again with the dividend in mind. First, capital investment. BP's targeted $16 billion for 2016 in a range of 15 to 17 for 2017. Second, disposals. The plan is $3.5 billion of cash raised in 2016, another 2 to 3 for 2017. And finally, cost cuts, where in 2017 BP's hoping to show a $7 billion reduction compared to 2014. All of those should help cash flow and thus the all-important dividend, but do keep watching oil prices as well and that OPEC meeting as we get nearer to it in May. Thank you for watching, and I look forward to seeing you next time.